Good morning, everybody. Happy Saturday to you all, regardless of where you may be dialing in from. Welcome. Thank you for taking time out on a Saturday morning. I value your time as I do my own, and we will keep this to just about an hour as planned. Very excited about the topic for today, which, as you can see here, is with regards to end-of-year tax strategies. We have my good friend Larry Dixon joining us, who will talk about some of those things, among other topics related to tax stuff, which is a very interesting and hot topic right now, as you all know. And so with that, we will go ahead and get started. I actually do have a special announcement to make prior to getting into it with Larry, however. So first of all, those of you who have been following us or are part of the team in some way know that we started our company a couple of years back under Redeem Realty Solutions, really focused on single-family homes, which is why you have a rooftop there represented in the logo. We did convert to Redeem Investments along the way, excuse me, in order to capture the fact that we were doing more than just single-family homes and had pivoted to doing commercial multifamily apartments, as well as some other things. And one of the things that we realized is that we wanted to ensure that our logo and name and color scheme reflected the new things that we were doing and the way that we were embarking on our journey. And so now Redeem Investments is still named Redeem Investments, but with a new logo here for you to see. And so I do want to explain that real quick. The tall buildings represent leadership and growth and aspirational goals of acquiring larger properties, not so much the single family homes that we started out with. The slats, or actually they look like windows to me, these slats in these buildings represent acceleration and transformation. The golden rising sun nestled between the two solid structures represent the redemption that accompanies each new day. And in many ways, the logo symbolizes our company's rising up or rise up and growth. And so from a distance, you'll also be able to make out a lowercase r and a lowercase I, the tall building on the left, and then the sun sort of represent the R, and then the shorter building, the I. And that stands for, obviously, Redeem Investments. And these letters are lowercase to indicate the fact that we approach our business with humility, the posture we take towards serving our investors and our communities. So that gives you a little bit of background on the branding change, as well as the logo and what it means. And so everywhere you've seen sort of the arrow pointing up with the rooftop, now you will see the new logo there. So very excited about that. We also are launching and have launched, it's live now, our new website. So here is a screenshot of that. And so very excited about that as well. And really just in the fact that we're able to display the things that we're doing, what we're about, information about us. And so as people begin to go on site to want to learn about what we do and how we go about doing our business, they're able to readily see that and engage with us there. So very excited about that. So speaking more about Redeem Investments and who we do, really this org chart, if you will, represents some of the different aspects of what we do. So for those who are not familiar, Redeem Commercial Real Estate, that's really our primary focus, and where we spend the majority of our time is acquiring multifamily assets. Redeem Concierge Services serves to allow us to add value to those very same tenants who live in those communities by offering them telecom and energy services, internet, cable, etc., that they would otherwise have to source outside or externally. We're able to provide those services to them, and of course, in doing so, we're able to extract additional value, and that obviously increases then the value of the property. The Redeem Team Mastermind I'll talk more about later. It's effectively a joint venture partnership program where we enable the pathway of people aspiring to become general partners in real estate syndications, to teach them how to do that, but then also partner with us to do that very thing. And then Redeem Realty Solutions, it sort of faded out in the background there simply because we're not doing a whole lot with regards to single family homes. But as opportunities come about, we do take advantage of being able to take those on as needed. Before I continue, I will say if there are questions, please do post those in the chat. I'm sorry, in the Q&A box, so that way I can ask those of Larry or answer them on my own, and that way we don't have to wait until the very end. Here's what we offer through our investments: accelerated or asymmetrical returns. In other words, we try to provide above average returns at below average risk, and through the properties that we're acquiring, we're able to do exactly that. Assets and really the tax advantages that come with that is part of what will be talked about today, and Larry will go into that. Joint venture partnerships through our mastermind, education resources, mentorship, those are really the ancillary items for our mastermind, things that our mastermind group is able to access, education, different resources that we utilize that typically would cost a lot of money. And what they say in real estate, Larry, I think you know this as well, is you pay me now or pay me later. And so people will have to effectively pay some form of tuition in order to learn how to do this stuff, whether that's upfront through some kind of an education network like we've done as well, or a mentorship program, or cutting their teeth on their own and possibly making a lot of mistakes that can be very costly. We try to eradicate those things for our partners. And then lastly, as I mentioned, the concierge services, there's a way for folks who are interested in providing those very same things. If, for example, someone is a realtor and they sell a home, they're able to then offer, instead of offering a list of the local providers that provide utilities or cable, internet, or phone services, they themselves, that very same realtor, could offer that and would get passive and residual income as a result of doing so. Lastly, and before we transition to Larry, the wealth formula, I think you guys have seen this if you listen to any of my presentations. Really, there's three main components of that. The first thing is the base of it, which is making money, and there's all sorts of different ways to do that. Obviously, depending on what your skill set is, will define, and your knowledge set will define doing that. The second component is keeping that money, and I think this is really where Larry Dixon, who's joined us today, will be able to speak to one of the major ways of how you can keep your money, whether people are advocates of or sort of look down upon how the tax code is written. There are tax advantages for people who own businesses and people who take the risks of purchasing real estate and the debt and servicing the debt and the liabilities that come with that in order to provide communities for people and create jobs. The tax code is written so that tax advantages are afforded to those people. And so we'll talk about that. And that's why I wanted to include this, so that you see sort of how that fits into this process and progress of the wealth formula. And of course, lastly, is multiplying money, and that's where investing comes in. So without further ado, let me transition to Mr. Larry Dixon, excuse me, a fellow West Point graduate who is cheering on Army today, just as I am, but he is currently serving in the military towards the latter part of his career there, and just the power of network is really how I'll introduce him, is that I was looking for other options that could help me with some of the more advanced tax things that I needed, tax help that I needed, and I wanted to look within my own network. And sure enough, as I did some research, I came across Larry's profile, and it was almost a year ago now. And since then, we remain in contact, and looking forward to working with him. But without further ado, I'll let him introduce more of himself and transition over to you, Larry. Let me give you the presentation. All right, Larry, welcome, and please introduce yourself, sir.
Hey guys, my name's Larry. I'm a 2015 grad. I majored in economics while I was at West Point, and I've been doing this for about 3 years now. So in 2017, I came back off a rotation to Eastern Europe. I kind of fell into trying to start a ton of my own kind of things that I wanted to do. I thought I was going to be a trainer. I thought I was going to be a streamer online. I thought that I was going to sell things online. None of them worked, but whenever you run your own business, you have to get really well acquainted with your accounting, your books. I had to figure out how to do books for each of those. And then I had to figure out what my tax situation would look like for those. Well, doing that, I started to make friends in different sectors, and I got really close to tax, and people would keep asking me these questions, and I just happen to have the answers. And then one day, one of my friends was like, "Hey, how much is it going to cost for you just to do all of this for me?" And I was just like, I never thought about that. And I was like, $70. And he was just like, too easy. And from then on, I just kind of built on. I kept learning. And that's kind of how I ended up here. I love real estate. I love investing in real estate. I love learning about real estate. So through my practice right now, I started my own company, Atlas Accounting and Taxes Solution. I primarily focus on real estate. And so that's why I kind of end up connecting with Christian. And that's how we end up here. I'm going to take you guys through how I see your guys' end of the year tax situation, how I think you guys can get ahead on that. And then please, if you guys have any questions at all, please let me know. Don't hesitate. Hold on. This one. Screen. So right here, what you see here is just, again, we're going to go taxes and real estate, right? And I love real estate because, again, this is Andrew Carnegie. Obviously, we all know him. 90% of all millionaires become so through owning real estate. Real estate is one of the greatest ways to grow your wealth, and we'll go over why that is. But I always am an advocate of everyone getting into real estate because not only does it increase your wealth, but it also gives you a chance to learn about tax and then save taxes at the end of the year. Now, this is the biggest problem that people run into with just their tax situation. You have to think of yourself as two people. You have your operation side and you have your passive asset side. Your operation side is generally what you're going to do if you own a business or if you have a W-2 income. And then the passive assets inside, that's stocks. But right now, and more importantly, our focus today, that's also going to be your real estate. Now, these two tax situations are going to be treated completely different. And you always want to work to put what you're looking at in the proper perspective. So we're going to obviously focus on that passive asset side. And now taxes is just an incentive structure. Christian kind of alluded to it earlier, like however you feel about our tax code right now, all it is an incentive structure for what the government wants to see. So our government has placed a premium incentive on wanting great real estate around America. And for that reason, there's lots of tax benefits that come associated with that to not only benefit our government, but benefit ourselves for putting our own money, investment, and maintenance into those real estate properties. And that's why if you look at our infrastructure, it generally sets itself apart from other countries. And then we get into why I think real estate is the mecca of investing. So we'll start at the top here. All real estate generally appreciates over time. That's just kind of something that's set in stone. You're going to see increase from anywhere to 2% all the way up to 5%, depending on location. But just having the real estate, you know that you're going to get a forced appreciation from it. You're also going to get a principal pay down. Once you have a rental property, the person you have renting from you, they're going to pay down your mortgage, right? So they're paying off the loan for you. So not only do you allow yourself to extend your money, but you also allow somebody else to take over payment of that loan. Although you're still responsible, it allows you to do more things. At the bottom here, we have cash flow, right? Obviously, real estate gives you tons of cash flow up to your, the Grant Cardone 100 and 300 door complex down to the single family home. It's one of the greatest things. You get more money from having real estate. Now, this is where it kind of sets itself apart from all of their investments, is that you can do all those three things. And then at the end of the year, thanks to depreciation, other different kind of write-offs, you can have a net loss on your income statement, which creates a kind of a safe harbor. So if you were to make $70,000 in your W-2 income, you can have a negative $2,000 write-off in your real estate company, and you'll only be taxed off on $68,000 as opposed to $70,000. We'll get into that a little bit later. So again, we have to identify yourself as an investor. This is a place where real estate investors really kind of get confused. There's really three categories that you can find yourself in. You have in the bottom here, the passive. So if you were going to invest in a syndication or other kind of REITs, you would find yourself in a passive location, right? Now, what does this mean for you? This means that when you get that negative loss as a passive investor, it can only write off, or it can only cancel out your passive gains. Think stocks, things of that nature, things that you don't actually work to get. Now, secondly, and this is where we most commonly are, it's called an active investor. It's either your property or you're making calls. You don't have to be there every day fixing everything, but you have to be the one managing it. You have to be the one making calls for, overseeing the process, as opposed to the syndication, someone's doing everything for you and you're just collecting a monthly, quarterly dividend, right? And then we go over to the real estate professional, right? Now, the real estate professional is the greatest place to be in the real estate world, right? So it has to be your primary occupation. It doesn't mean that you have to work only in there, but you have to devote enough time there to say that this is the majority of time. And this is where it gets fuzzy with the IRS, because it's kind of subjective, but you have to make it look like it's your primary focus. And that means you have to at least spend 750 hours throughout the entire year. That's roughly 14 hours a week. So that's a good amount of time, right? So once you cancel all those two things, it comes down to the material participation, right? And there's 7 tests for those, and they're fairly easy. We can go over those later if you have a specific question, but generally I would just pull up the 7 material participation and see if you can check those boxes. Generally, if you have 750 hours, you're going to check all those off. Now, the real estate professional is different than the active investor, is how much you can write off. If you're an active investor, you're going to be capped at $25,000 of loss in a year. Sounds like a lot, but as you get aggressively into real estate investing, you're going to see that that number's not quite big enough, right? The real estate professional, there is no cap. So once you check that box, you can write off as much loss as you want to. And as you can see, it can get as aggressive as we need to over time. So the first step that everyone needs to do is have to stay clean, right? And this sounds super weird, but it's always in how you're going to organize what you're doing with your business. What does that mean? Your books. You have to have, at the very least, an income statement for your books. So every single month, you know how much you made in rents, and then what you're writing off in expenses. And you need to get that on paper. And here's the important thing. Please start keeping your receipts to back it up. Now, I'm not going to say you're going to get audited. So if you don't get audited, no one's ever going to come and look at your receipts. But it's a very good practice because they do random audits on different sectors of industry, which means real estate can randomly pop up. And then they're just going to choose random people. If you don't have those different receipts, they can just throw out different costs, and that can really mess with your tax liability for that year. And then obviously interest, penalties, things of that nature. So get used to keeping an income statement, please. How much you made minus what you lost, your net profit, and then keep your receipts to back up those expenses. Now the records, obviously the records are receipts, but no, keep records of time, right? So the deeper you get into real estate investing, you are going to have to start keeping a time log. There it is, the time log. And this is big, especially as you try to approach the professional real estate, those 750 hours, right? Now, here's the thing about the time log. It's not the time that you do on the property. For example, a lot of my clients say, well, hey, I didn't replace the fence. I can't count those 12 hours. That's not true. You oversaw it and you watched it get done. You're actively working in the property. Those 12 hours go onto the log to replace the hours. Now, again, that may not count to your 750 hours, but it's going to count towards your material participation in the property, right? And again, get used to this process. Get used to keeping the records when you travel, when you have work done, when you do anything for your property. Secondly, keep them clean, keep them organized. Another problem that I see is that people come to me at the end of the year and they just come with a gigantic pile of mess. And I have no other option but to just charge them more for their time, right? The dirty little secret when you go to work with an accountant tax preparer is especially if you don't have a relationship, they're going to charge you based off of how much time it will take them to do what you do. So the cleaner you take them, you're going to save money, but secondly, you can have a better conversation. When someone comes to me with messy receipts, messy logs, and I'm spending time organizing for them, they're not ready to have upper level conversations on how I can save them more money. They're just looking to have a task completed. And again, as we transition from, having one property to 10 and wanting to make this into a business and wanting to take this to the next level, you want to get to that next level of thought, right? So that cleanliness and that organization signals that you're ready for development and more tax write-offs, more structures, more accounting, things of that nature, right? To get you ahead and ultimately make you more money. And so again, we go to picking the fruit, and these are just the basic deductions, right? These are just what you'll generally see. These are just kind of the low-hanging fruit that kind of exist. And so the important thing is to treat your property like a business, right? So these are the 8 things that kind of get all the categories together, right? And so some of these things you already know, the taxes, the property taxes, the local taxes, what do they call them? Community funds, housing association fees. My least favorite thing in the world is a housing association. But
It
those
sure
fees are all
will.
taxable, right? You have your interest in points. Again, this is normal. Your house insurance, any insurance that's tied in, any liability insurance, anything like that, obviously is writable. Depreciation, again, we might touch on this a little bit more. I kind of see a lot of confusion, but obviously depreciation is easy to write off. Now, these are the things where every time I get to the end of the year, these are the things that's always forgotten. Your travel, right? When we get past this point of time where we are and we can travel freely and we go back to living their life, if you travel for real estate, whether it's to travel to look at more properties, whether it's travel to look at a conference, whether it's to travel to talk to your business partners, this is a business expense now, right? You're doing something for your business because, again, our property is a business. You have to treat it like a business. Anyways, so the travel, right? So that means your flights, that means your food when you travel, things of that nature, your lodging. This is really important. And again, this is a lot of money, right? A trip from here to Washington for me to look at a property, it's $536. $536 times roughly 25% at my tax rate. That's roughly $127 that I'm saving in real dollars at the end of the year. That's massive. The repairs. Now, break your repairs down into the smallest level possible, right? What do I mean by that? For example, I had a client say, hey, I got my top floor done, right? It cost $50,000. Some accountants would say, hey, we need to capitalize this over 5 years, right? Or 7 years because it's an improvement. And then by breaking it up to, hey, we replaced the toilet. Hey, we repainted the house. We repainted the bathroom. Hey, we redid the floors. All those individual purchases to redo the top floor are going to come under $2,500, which means they can be expensed, which means they can be taken in the year. Now, again, by breaking them up and keeping them organized, you can sit down with your account and then we can have a different kind of conversation. Rather than get you out of the door, we can talk about, hey, what's your tax situation like? What's your tax liability for this? What does your next 3 years look like? These are the kind of things that you can do when you're organized and you start treating it like a business, and you kind of understand what can be written off and how it can be, not only what, but how it can be written off. The home office deduction of the vehicles. You need to start tracking it. Go ahead and measure out your home office. People constantly forget this. Your vehicle, I would get with an accountant, whether it's me, you contact me, whether it's a friend. You need to decide if you're going to write off miles or if you're going to take actual expenses. Again, this seems like a lot, but these are important things, low-hanging fruit that can really save you money. Last, self-improvement. I didn't really know how to write this one. Some people call it self-improvement. Some people call it education, things of that nature. When you join a mastermind, such as Christian Mastermind, which I think is a great idea, you can write that off. That's a tax deduction because you're trying to improve your knowledge in your business, real estate. When you go to a conference, that's tax deductible because you're trying to improve yourself in your business. All the things that make you a better real estate investor and or professional is a source of self-improvement, which is a tax write-off, right? So again, what's happening here? The tax code is incentivizing you to be the best person you can be in your business. Always understand that. If it's ordinary, which means that it's kind of normal, obviously you can't travel to Dubai if it's not for a very specific conference. And then if it's necessary, is it necessary for your business? Well, improving yourself is always ordinary and improving yourself is always necessary. So always remember that. Again, those are the 4 things where when clients come to me, it's either not there because they didn't think they could take it, or it's not properly organized. So it's tough to see how it's going to populate onto the tax return. Now, this is the next level strategies, right? Now, this one, we're going to focus on cost segregation. This is kind of the big one. If you have a multi-property, even if you have a single property, this is one of the biggest things that can be done right now to save you the most amount of money at the end of the year. Now, it's called a cost segregation study. Now, the average person should not do their own cost segregation study. The average tax accountant or CPA does not do their own cost segregation. You're going to want to hire generally an outside firm that's going to be an engineering firm, right? What is a cost segregation? It's the process of breaking up your massive property, your house, your multifamily property, into smaller pieces. Now, why would you do that? Your property, if it's a rental residential property, the depreciation is over 27 years. The commercial property is over 39 years, right? By breaking that property into smaller pieces, the appliances, carpeting and furniture, or the equipment, or the structural improvements, you can take this depreciation in less years, 5, 7, or 15. This is going to give you more depreciation, which means a bigger tax write-off. And then obviously some of those can have an accelerated depreciation schedule, which is even more, which is, again, we can get into that later. But that's the process. This is the biggest thing. Now, people generally shy away from this because the cost segregation can cost you a lot of money. I've seen them upwards to $3,000 to $10,000 based off the property. Now, you always want to sit down with your CPA before, during, and after to figure out, is it worth it? What's my situation now? What is it going to be? What's going to be in the future? And B, like, can I fit it in? And then C, like, how will this affect it going through? Now, this can be a big thing. Obviously, again, you can easily see, but you'll pay $3,000 to $10,000, and you can easily see. The last one I saw, they paid $4,800, and they saw $48,000 in tax losses. And again, they couldn't take all 25. They could only take $25,000 in that year, but then you have the carryovers or the carry forwards and things of that nature. So again, it's a massive savings of money by investing in a company. Again, the cost segregation itself is tax deductible again because it's something that's going towards your business. So that's the big one that everyone needs to be looking at. So I think you should sit down with your financial advisor, your CPA, your tax accountant, whoever it is, and ask them the question. Now, this is where you kind of get into the theory of, should I have a CPA or should I have someone that's geared towards taxes? Or geared towards real estate. I love real estate. I spend most of my time there. I think you should get a CPA, a tax accountant that is in the real estate world. Why? Because when you have a strategy like this, the average CPA is going to understand what to do with these categories of 5-year write-off or depreciation schedule, a 7-year depreciation schedule, and a 15-year depreciation schedule, but they may not be familiar with the cost segregation. So what may happen is you will spend more time explaining the cost segregation than he will giving you advice on how to utilize it. By getting someone, a tax professional that's in the real estate world, they'll know these strategies and then they can guide and walk with you through the process. This is big as you start to go from 1 property to 3 to 7, right? We understand that the first property is the hardest, but the next is always easier. So I highly always recommend to have the conversation with your tax professional and try to figure out how deep they are into the real estate world. It really matters when you're starting to extract the most amount of benefit from them because you're going to pay them a lot of money to do the service. But again, they should be giving you more value than you're paying them for. So structures. This is kind of a question we can talk about it. I generally, anytime I talk about real estate, this is the primary question I get. What should my structure look like? Do I need an LLC for my home? Should I do a multi-LLC? Do I have a corporation? There's really 3 categories that I place people in. If you have generally 1 property, especially the 1 property in the same state as you are, you don't generally need an LLC, right? What does the LLC do for you? It provides you liability protection between you and the home. So if something happens on the property, you can't be sued and take. Most people don't build up the corporate veil properly, so it ends up breaking anyways. Secondly, LLCs cost more money, so it's a cost-benefit analysis, right? So generally, with the 1 property, it's not going to be enough benefit. I recommend going to get a liability insurance. Just get an umbrella policy over you for about $1 million, and that should cover you for anything that happens on the property. Now, as we start getting real estate in other states, as we start getting multiple types of real estate, renovations versus turnkey rentals versus flipping, as you start doing multiple different things in the real estate world, and as you start getting more properties, the LLCs start to make sense, right? Because again, the thought of the LLC is to build the corporate veil, but it's also to separate you from that process on paper, right? And then the multi-LLC, or the series LLC, right? You'll have a multi-LLC or series LLC, or the C corporation. You'll see people set up companies at this level in Delaware, Wyoming, or Nevada. There's a lot of fees associated with this, and it's not going to save you any money in taxes, right? So if you ever hear someone say, hey, set up your LLC in Delaware, set up your C corporation in Delaware, Wyoming, or Nevada, but you don't live in those states, understand, if they say do this to save money on taxes, they're completely wrong. It will not save you any money in taxes. Where you live is where you will pay taxes, right? So although I have a rental property, or you can have a rental property in, say, Florida, right? So, and then you set up your LLC in Wyoming, but you live in California, it doesn't, you're still going to pay the taxes associated from having the LLC being stationed or set up in Wyoming. You'll still pay the property taxes in Florida, and then you'll still pay the state taxes in California. The LLC, the corporation, will not stop you from paying taxes, right? You always want to do that for the legal reasons associated with that. So as you start wanting to have that conversation, again, understand the kind of conversation that you're having, right? And I don't think the LLC, multi-series LLCs works right now for most people. But if you want to have that, it's a very specific conversation. But I wanted to put that out there because I've been hearing it a lot lately, especially with other clients, that let's set up in Delaware, let's set up in Wyoming, let's set up in Nevada, when it doesn't actually save you any money on taxes. So I always want to touch on that.
Hey, Larry, let me go. Can you go back real quick? Because I think there's something important that I want to mention here as it relates to commercial multifamily, and that is, you're exactly right. The LLC is the one that's most commonly used within that space. In fact, a single purpose entity, i.e. an LLC in our case, for each of the different properties that we acquire is absolutely essential. And that helps to safeguard us as a general partner from anything that might go on with the property, because the property itself is within that LLC. Our general partner is the manager of that LLC. And then also the other piece as it relates to that is when you go to source debt funding, they will absolutely require that you have an LLC, and the LLC serves as the borrower with that loan servicer. With regards to the multi-LLC or the series LLC, something interesting that we found as we went to go open up bank accounts for these apartments is that we inadvertently created a series LLC and they would not accept it. And so interestingly, and this was with one of the larger national banks, actually international banks. And so that would be a takeaway there, is that there are some banks that will not accept a series LLC for an apartment building. They want it just to be sort of your run-of-the-mill LLC for that. So anyway, just wanted to mention that real quick.
100%. And I like to say this out front just to kind of jump on top of that, is you have to understand your situation, which kind of comes with being organized, understanding where you are, having everything organized. So when you have the conversation, you understand what you need. Mm-hmm. To jump on top of what Christian said, not every single state even takes the multi-series LLC. And I say that because a lot of people recommend that because it means more money when you may not need that, right? So you always want to understand what you're going. As you go into joint ventures, things of that nature, the LLC easily comes together when you're developing partnerships and joint ventures. But again, I just like to throw that out there just so you're a little bit more dangerous when you walk into a consultation, a meeting of any sorts. But yeah, other than that, do you have any more questions, or how can I be of value?
No, I think this is really great content so far, and I think for those who are familiar because they're in the game, sort of are following along very well. I think for those who may be newer to it, this is good education and good exposure, but something that you would want to sort of review. And so definitely watch this again, or seek out additional information that would help you continue to learn about this kind of stuff. Is there any additional information that you want to share, or do you want to move into the Q&A portion at this point, Larry?
Yeah, I'd like to move into the Q&A portion.
Okay, all right. Well, thanks for that. Really good stuff. So I think you touched on it earlier, but I think I'll still go ahead and pull the pin on the grenade, which is sort of the elephant in the room with regards to this whole tax thing, and whether it's a good thing to mitigate your tax liability or not. Obviously, from a business owner standpoint, the answer is clearly a yes. But to those who may look at other people who strive or have looked to reduce their tax liability to zero and are frowned upon for doing so, maybe talk through that and what your thoughts are on the tax code itself as a vehicle and incentive structure to mitigate tax liability. So let me pull the pin on the grenade and throw it over to you.
So this has obviously been talked about recently for obvious reasons. Donald Trump, $750 on his last tax return. So the important thing to start this conversation is understanding avoidance versus evasion, right? So avoidance is minimizing your tax liability through legal measures to pay the least amount of taxes, and then evasion is just not paying your tax liability that the IRS says you have to, right? I personally am comfortable with using the tax code to pay the least amount in taxes. I think we should all pay taxes, but we should never pay $1 more than we have to. And so the question is, how much money do we have to pay into the system? I think the tax code is what is the agreement on America on what we have to pay into the system. So I am comfortable with everyone using the tax code to their fullest advantage. And I think that's why people should be educated. I think the problem that we've seen is just kind of an asymmetrical knowledge of the tax code. And generally that is because other people can afford to pay people to do it. But I definitely think you guys should get really intimate with saving as much money on your tax liability. And the question becomes, well, why do you think that? I think that the best vehicle for investing back into communities, back into our businesses, back into our real estate properties is ourselves. I think we would do a better job investing in ourselves than someone else would investing in us. So I always say, take that money. I'm just not a frivolous person anyways. I take a lot of money, invest back into my education, back into my business, back into growing myself. And generally what you see in people who have very healthy businesses, they take that money and they put it back into the properties, right? And so when you see the tax hike in the real estate sector, essentially, you see properties that are more run down, less maintained, right? Our first job is to provide a home for our tenants, right? That is literally our service that we're providing. They won't pay us if we don't do it. So by saving that money on taxes, it leaves money to invest back to the property to make sure that that home's well kept, right? That could be the difference when you're talking saving $4,000 on your taxes. Well, that can be a roof a year or two earlier, right? $4,000 over 3 years is $12,000. That's going to replace most roofs in America, well, at least in the South where I live. So I'm a big proponent of using tax avoidance as a strategy to invest back in ourselves, back in our businesses, our assets, and things of that nature. So that's always been where I've gone. But again, doing it the legal right way. There's a clear line in there. And then if you don't know, the tax professional that you work with should know. And not crossing that line is your way of acknowledging that, you're adhering to the system that we've put in place. And that's led to a lot of prosperity.
Good stuff. Thank you for that. Real quick, for those who may have questions that you'd like me to ask Larry, please type those questions in the Q&A section. So that way I can read that and ask Larry those questions. I see some people with their hand raised, and so please write your questions out. That way I can read them exactly how you would like me to do exactly that. Going back to one of the things that you about car, a vehicle to be used for business purposes. In your opinion, is it better to lease or buy a vehicle for your business? And if so, in either case, should and can that be done under your personal name versus your business name? What would the impact on taxes be depending on that?
So we'll start. There's two questions there. So we'll start. Do you want to buy or do I want to lease? It depends. It always depends. So anytime you ask a tax professional anything, they're always going to say depends because it depends on your situation. So it depends. I have to say that. But I like to own my assets so that this is just a personal thing, right? I like to own everything I have. It just keeps everything a lot cleaner. So I generally buy, but if you lease, there is a little bit more room because you get to write off that interest and the depreciation, but you don't have to worry about keeping the asset. But I generally recommend people, especially doing under $1 million on net worth, to buy. And that just keeps your books cleaner. That keeps that you're tracking your basis cleaner. It's a little bit cheaper and it's a little less stress on the person, right? Because when you start tracking bases and things like that, it can be confusing for a person that has a main job and then has properties on the side. Now, as opposed to buying it in your name or your business's name, for the tax situation, it makes no difference, right? So if it's in your business name, it will still populate on your Schedule C, your 1065, or your 1120 or 1120S. If it's in your name, it'll do the same thing, right? So the write-off doesn't really change. Keeping it in your business name, this is kind of the question you have, especially for real estate people, is building credit in your LLC's name, right? And that's kind of the hardest thing to do, corporate credit. So if you wanted to keep the loan in the LLC's name, or if you want to take out a small loan from a bank and then keep it in your LLC's name, this is a way of establishing credit for your LLC over time, which will again help you with raising more money. So if the question is tax savings, there's no change. If it's building LLC credit, there's definitely an argument for putting in your LLC. But again, it's so dependent on the specific person.
Got it. No, that's good. And clearly, for those listening, there are a lot of nuances and a lot of intricacies that really would someone would benefit from having an advisor and a tax strategist like Larry to talk through those things. A question just came in, actually two. One was about, similar to what we just covered, whether about a company car versus mileage, which is a better approach. So let's hit on that real quick with regards to mileage, Larry, and then I'll ask you the next question.
Yeah, so company car versus mileage. So they didn't really ask the question properly. What they mean is, should I take the mileage or should I take actual expenses at the end of the year, right? Mm-hmm. If you own the car or your LLC car, but sorry, let me rephrase that. If your LLC owns the car, it's for your business. If you own the car and use it for the business, it's for the business, and the expenses are tax deductible. So like that's kind of the first confusion I see people run into. If the car is used for business, it can be written off, whether it's in your name or the company's name. Now, the second thing, should I use actual expenses or should I use mileage? So this is always why it brings it to my next point. A lot of people only talk to their tax professional at the end of the year. I really think people should get comfortable talking to them 3 to 4 times, at least quarterly, right? But I think more, honestly, monthly. It's worth the money because the question is, or the answer is, it depends, right? So for the actual expenses, you can write off gas, oil, car washes, tires, maintenance, depreciation. But how will you know if that's more or less than the mileage you take? So you get 57.5 cents for every mile you drive. And so the only way that I could answer that accurately is to see what you spent on it or what you spent on your car and actual expenses, and then how many miles you drove. And so with my clients, I'm going to sit down and I'm going to do the analysis. I'm like, okay, well, how much did you use the car this year? Are you going to sell the car? How much are you going to use the car next year, right? And then how many miles are you driving every year? And so you have to sit down on an Excel sheet or a program, and you have to enter all those numbers in, and then you have to have a back and forth on it. So both can be beneficial. I've used both. I have clients using different ones for this year. I have different clients use different ones. I have 2 clients that are using different ways of measuring it for the vehicles within the same business. So again, it's very important that you get in front of people and you kind of have these back and forth talks. And again, 30 minutes, 12 times a year can save you a lot of money come tax time.
Nice. Okay. Thank you for that. Yeah, we personally do actual expenses, but we also track mileage because depending on how many miles were used for business purpose is how much of the actual expenses can be written off, is my understanding. Is that right, Larry?
No, and that's it. And that's why both need to be tracked, right? Yeah. Because even when you get the actual, if your car is not solely used for business, so generally real estate agents, you see this, the percentage of mileage driven for business as a proportion for your normal life, that fraction that percentage is going to be what your actual expenses is. So that's another reason to track both.
Got it. Okay. Yeah. Next, the other question that came in says, I currently live in Texas, but have 2 Nevada LLCs. One of them is a sponsor LLC for a solo K. How do I go about moving them to Texas?
So solo K, that I don't.
Solo K is like a retirement account.
A solo 401k.
Yeah.
So this this is tax, and this is bleeding into a lawyer, right? So I'm not as like up to date on how to transfer the LLCs. As far as the 401k, I know moving it from Nevada to Texas won't incur any kind of taxation, right? And so moving the LLC's location won't change the way that's taxed. You won't incur any kind of tax as long as it doesn't leave that account, right? But as far as moving your LLC from Nevada to Texas, I would consult a lawyer again, but it depends on what you're doing in each of those states, and I would have to know what each of those activities are in each of those states.
Okay. Yeah, so from a tax perspective, it doesn't sound like there would be much of an implication, but rather more from a legal standpoint is how you want to
100%. Like tax-wise, that solo 401k, or I'm assuming it's solo 401k, won't change in the way that it's taxed or the way how much money you can contribute to, as long as you don't go over the limits.
Got it. Okay. What about just obviously again the title of this is End of Year Tax Strategy. What would you say is your favorite tax strategy if you had to pick one?
So this isn't my favorite, but this is my favorite one to give my clients, right? So this
Okay.
one is the easiest one that every single person, if you own an LLC, if you own an entity, right? So if you have an LLC, an S corporation, C corporation, anything of that sorts, right? This can always work. It's called the Augusta tax clause, right? This one was born because of the golf tournament. I'm not super tied into golf, so I don't know a ton about golf, but I know that the Augusta tournament, or the tournament that happens at Augusta, is one of the biggest times of the year, which is increase the rental properties by a drastic lot. So if you rent your property for less than 14 days of the year, you don't have to claim that money from rental income on your tax return, right? And that's big. So what I have a lot of my clients do is they rent their homes that they own out to their business, or they sublease the place they're renting out to their business, and they have business meetings at their home. This is big, especially towards the end of the year. Excuse me, because for example, one of my clients is a reseller, so he's obviously going into his biggest quarter. So I'm going to fly up there 3 times, and we're going to have three 2-day weekends where we just go over business strategy. We're going to keep minutes, records. And then, but again, he's going to rent his property to his business, he's going to rent his property to his business at roughly $1,000 to $1,200, and then overdoing that 6 to 10 times throughout the year, that's going to save him $12,000 on his taxes. Which again, if you're taxed at the 30% tax rate, that's going to save you $4,000 at the end of the year. So the biggest one that I always give to my clients, kind of an easy nugget to execute, done properly, is something that can map onto a ton of sectors, even real estate, is again the Augusta loophole.
All right. I think we'll need to talk about that one here. I'm going to call you come Monday to talk more about that one. I like that.
Yeah, it's a big one that people miss. And again, it's very legal. A lot of people think it's shady, but again, this isn't tax law. So less than 15 days, so 14 or less days out of the year, rent your property to your LLC, draw up a lease structure. Again, it's easy, but records are everything, right? Records are everything. So that's a big one.
Got it. Okay, thank you. Another one just came in. What should we be thinking of in advance when adding doors to our portfolio? Buying them through LLCs, through IRAs for our kids, etc. I guess so. Just ask. Mm-hmm.
Yeah, so this is a big one. So there are 2 questions. So I'll hit the first one first. So adding doors to your portfolio, records, right? Records, documentation. This is kind of where I see like the biggest one is like, obviously when you pull your tax return, they get everything, right? Anytime you go to get a loan, they pull everything, obviously. And there's 2 things that taxes matter come buying a new house, come buying new doors, right? It's your taxable income, and this is kind of the other side to reducing your tax liability, is paying more in taxes is also qualifying for more money. So sometimes I won't rip my client's tax liability down to 0 because you want to see the most amount of income, because they're like, hey, I'm going to buy 2 properties in the next 2 years. Like, okay, well, you need to make a lot of money on this tax return, which means you're going to pay a little more in taxes. So as you're looking at, especially next year, if you're going to buy in 2021, is you want to see, okay, what's that sweet spot of having the most taxable income on my tax return so I can qualify for the most amount of money. Secondly, our records and organization. Organization like kills people. And again, I'm not a real estate professional. I work with a lot of real estate people, right? So that means I sat in with a lot of loan officers with my clients, talking to other people, just as an advisor, right? But the organization, right? Being able to get things that you need, pull things together, and then the better your file looks when you give them to them, the easier, the faster you can get it, the speed to the deal matters. So again, organization in your records, and then tax liability, right? So if you're going to buy doors, especially some multiple properties or multiplex, like it may mean paying more in taxes in that year so you can qualify for the most amount of money. Buying them through LLCs. So again, this is a big one. I generally prescribe to buying them myself and then moving them to my LLC. A lot of people say it's a due on sale clause because there's the transfer of the title from me to my LLC. I've never seen one. Again, I've been on 3 years, but I have 5 mentors, 4, but 5 because I talk to them a lot. And they said they've never seen it. And between them, they have over 112 years of experience. So they've never seen a due on sale clause when you transfer the title from your name to the LLC. So I have not yet bought a property through an LLC. But again, even in that same organization and the LLC is you want proof of income through the LLC, great records, and then the tax liability, it's still going to be your taxes because of the way the pass-through works. But again, records, and then start establishing credit with different banks around the property you want to go to. So if you're like, hey, I'm going to go invest in Dallas, Texas, you want to start talking to credit unions down there and be like, hey, can I take out $1,000 loan here and then pay it off quickly? Because again, establishing that corporate credit, which is going to help you qualify for more money. And then through the IRAs, sorry, go ahead.
No, go ahead.
And then through the IRAs, you're talking about a self-directed IRA. These are my favorite. This is super, there's rules, right? So get with your financial advisor, right? So whenever I've talked about this, it's been a three-way conversation. It's been client, me, tax advisor, or financial advisor, because financial advisors don't always love it. But if you get a self-directed IRA, you obviously put money in there, and then you can buy, and again, get with your financial advisor. But you buy the property in the IRA, right? This is big because any rent that you get has to stay in the IRA, right? So the rent has to go right back in there. And if from talking to you, it seems like you want to put it in your IRA and then give the IRA to your kid, which is completely legal. But remember, there's so many rules. I would just get with the financial advisor or get with me offline, obviously, and then we can talk through more. But essentially, save money to your IRA, invest, liquidate stock in your IRA, buy the property to your IRA, and then obviously it's just going to be managed inside there. There's just there's more rules. So
okay, all right. Let me do this, Larry. So let's go ahead and land the plane here. You know, how would someone go about finding a tax professional, and what would they look for? What should they look for in terms of evaluating?
So tax professional, again, the best way to meet a tax professional is to do a consultation with them. Generally, at least a lot of the ones that I work with, that first consultation is rarely, if ever, paid for. But I would take them and then I would ask them questions about your situation. It requires you to start getting educated in the real estate sector, but I would quiz them on cost segregation. I would quiz them on the 1031 exchanges. I would quiz them on flipping. You have to quiz them from the baseline knowledge that you can acquire, which is going to mean that you're going to have to do a little bit of reading to be a little bit dangerous walking in there. There's just no other way to do it. But I would take more consultations, and then I would get involved in groups like real estate or whatever sector that you want to find one focusing in there. But for real estate, I would get involved in more real estate groups like this mastermind, and I would start asking them questions to ask them, because essentially you have to walk in there with a questionnaire and then force them to prove their worth to you. And again, if they take offense to that, the relationship may not be worth it, right? Like it may not be, hey, do this work for me, but if they can't clearly and intellectually articulate the value they can provide for you, then that means they have not earned your service.
Got it. Love it. Love it. Okay. Hey, Larry, if you can make me the presenter, if you can hand it back to me. Actually, I got it. I'll take it back, and then I'm just going to go ahead and just quickly try to wrap up here because I want to honor what we said as far as keeping with the time. And let me share my screen. Let me know if you can see my screen and what it says.
It says now what?
Okay, perfect. Okay, first of all, Larry, hey man, thanks so much for all the content, for answering the questions that were posed. Really, really great stuff. Really hope that the folks who dialed in here, listening live, as well as anyone who gets a chance to listen and watch this presentation has gotten a lot of value from it. Before we go to close and I show my information here on how people can contact me, what is the best way for folks to contact you, Larry?
The best way, I will actually send the email out, but my email is larryd@atlasants.com. And then yeah, if you just send me an email and I'll get in touch with you there.
Okay. Got it. Yeah, I think the thing I like about Larry is he is poised to grow his business like like through the roof, and I can see that happening for him. You guys didn't catch it, but he has aspirations to pursue a law degree, which I think is just going to set him even more further apart from others in his space. But he's also sort of small enough now where he's accepting new clients, and he has all the knowledge that anyone in this space would need in order to feel really comfortable about working with him. So definitely contact Larry. So now what I would say, let's look at this. To learn more, this is our website. Definitely come onto the website and check it out. If you want to invest with us, this is one way to contact us on the website. There's also a link there that you can click on and input your information, so that way we can reach back out to you and let you know about upcoming opportunities to invest. We're looking at bigger and bigger deals now, but with the mastermind that we have created, we're able to look at much larger deals than the ones we've acquired so far. We're looking at apartments that are in excess of 100, 200 units, and we definitely have room for additional investors. You can join our mastermind. So those who, actually, let me tell you who Mastermind is for. Given that it is a joint venture partnership program, it's really ideal for those who want to become a general partner or syndicator for real estate deals, namely ones where you are having to raise capital and aggregate funds in order to do that. It's definitely also for people who are willing to contribute and hold themselves accountable. The part of the mastermind is this group called Monthly Accountability Group Session, where we feature a keynote speaker like Larry, but then also thereafter meet as a group together and talk about any relevant topics, maybe debrief on what was just discussed, and talk about any upcoming deals or help or any resources or anything that somebody might need. It is definitely not for the average person who is only seeking to become a limited partner. We definitely have opportunity, as I mentioned, for folks like that. But for those who want to actively become a real estate professional, like Larry talked about, and become more active in the business, this is a great way to do exactly that. It also provides access to invaluable resources. The documents that we have available to our mastermind members, the legal documents alone cost me $10,000, and I'm willing to provide those templates. Obviously, we'd still want those to be reviewed by a real estate attorney or an SEC attorney in this case, but at least the templates are there to get started. Training events. In fact, one of the things that I'll mention here in a minute is some of the upcoming events that we have coming up. And we did launch in July of this year, so just a couple months ago. We still have room for additional mastermind members. We are running a special promotion, as we do for folks who attend the MAGS session like we have now, and the promo code for that is MAGS. So when you go on to redeem.com/mastermind, you can type that in, and that will give you that discount. So upcoming events, 11/14, so our next MAGS session, we will feature a commercial real estate broker, also happens to be a fellow West Point graduate. On the December 9th, we have our next MAGS session during that month is going to be with an SEC attorney, talking through the capital raising and all of the legal documents that are necessary, and really just a wealth of experience. He was himself a real estate syndicator for 20-something years. He went to law school and now has been in practice for well over 30 plus years or more. And then lastly, the thing that I'm really excited about is on the 20th of December, the Cowboys, I believe, are playing the 49ers at home, and we will use that event as our Q4 meetup. One of the ones we had earlier this year was at Mark Anthony concert, where I provided a 2-hour seminar, followed by us all going to the concert in a box suite with dinner and everything else was really nice. The one that we did this past quarter was in Orange Beach, Alabama, where folks came out. We spent the entire day on the water, deep sea fishing, and it was really fun. And then I did a presentation, a master class over dinner, and then now we'll do something similar, but the social aspect of it will be the Dallas Cowboys football game there in Arlington, and we'll do a property tour as well of the property that we have in Arlington, and show you what that now looks like and just how different it is versus when we first acquired it. So all that said, we are done with this portion. Thank you again, Larry, so much for joining. Really appreciate it. And for those that dialed in, thank you for spending some of your time here on Saturday. And hope you guys stay well and healthy. God bless. Take care.